Welcome to this deep dive. We're going to be exploring investing through the lens of Philip Carret. You've provided us with some great sources to work with, including Carret's own writing, to understand his approach to investing.
What's fascinating about Carrot is that he was successful long before names like Graham and Buffett became synonymous with value investing.
Okay, so let's unpack this. We'll be
Yeah.
exploring how Carret pioneered the first mutual fund, the strategies he used to achieve some pretty impressive returns, and of course his relationship with Warren Buffett. But first, let's dive into one of the core concepts that Carret emphasizes in his 1930 book, The Art of Speculation. And that's the distinction between speculation and investing.
You see, Carrot uses very specific dictionary definitions to clarify this difference. He says speculation involves intellectual examination and expectation of a price rise. And he contrasts that with gambling, which relies solely on hope.
It's not just about picking a stock and hoping for the best. There's actual analysis involved.
Precisely. He gives the example of betting on a horse race versus buying stock in, say, Mack trucks. Betting on a horse is purely gambling, but buying stock in Mack trucks, after carefully examining the company's fundamentals and potential for growth, that's speculation.
That's a great example. It makes the distinction crystal clear. So he's saying speculation, when done right, can actually be a form of investing.
Exactly. And this distinction is crucial to understanding how Carrot approached the market. He wasn't interested in quick flips or getting lucky. He believed in informed, thoughtful decisions based on research and analysis.
So it's all about understanding the true value of a business. And speaking of understanding value, this is where it gets really interesting. Carrot didn't just write about investing. He actually put his principles into practice in a groundbreaking way. He created one of the world's first mutual funds, the Pioneer Fund, back in 1928.
And that's not all. He managed this fund for a remarkable 55 years. Imagine steering a ship through 31 bull markets, 30 bear markets, and 20 recessions, including the Great Depression.
Wow. Talk about a long-term vision. That alone speaks volumes about his commitment to his investment philosophy.
Absolutely. And the results were staggering. A $10,000 investment in the Pioneer Fund under Carrot's leadership would have grown to an astounding $8 million.
$8 million. That's just mind-blowing. Can you put that kind of growth into perspective for us?
To understand the magnitude of that achievement, you need to look at the compound annual growth rate, or CAGR. Essentially, KGR tells you the average annual rate of return an investment needs to achieve to grow from its beginning balance to its ending balance, assuming profits are reinvested each year.
So what was Carrot's KGR over those 55 years?
Well, the exact number might be difficult to pinpoint without delving into complex calculations, but achieving that level of growth over such an extended period indicates a very impressive KGR, significantly outperforming the market average.
Okay, so we're talking about a KGR that would make any investor drool. But what was his secret sauce? How did he actually achieve these incredible returns?
Well, Carrot was a value investor, even before the term was widely popularized. He focused on finding undervalued companies with solid fundamentals and holding them for the long term, a strategy that clearly paid off over time. And here's something remarkable. His firm, Carrot Asset Management, still uses his approach as the centerpiece of their investment philosophy, even today.
That's an incredible legacy. They even have his famous 12 commandments of investing on their website, right?
Yes, they're like a condensed guide to Carrot's investing wisdom. He covers everything from diversification and regular reappraisal of investments to a rather colorful warning to avoid inside information as you would the plague.
Sounds like we need to delve into those commandments a bit later. But before we do, let's shift gears and talk about Carrot's relationship with Warren Buffett. I mean, we're
Right.
talking about the Warren Buffett here.
We are. But even Buffett himself acknowledged Carrot as a major influence, calling him one of the greatest investors he'd ever known. In fact, Buffett once said that Carrot had the best long-term investment record of anyone I know.
Wow. That's incredibly high praise. Coming from the Oracle of Omaha, did they know each other personally?
Yes, they did. Buffett even mentioned Carrot during a 1996 shareholder meeting, specifically praising his 1924 book, The Art of Speculation, for its insights on identifying good businesses and holding on to them.
Okay, that is pretty cool. I'm starting to see how Carrot's influence extends beyond just his own investing success. He's had a real impact on the way people think about investing. But let's get back to the Pioneer Fund for a moment. You mentioned that he founded it in 1928, right in the heart of the Roaring '20s. What was the investing landscape like back then, and what inspired him to create the world's first mutual fund?
Well, the 1920s were a time of incredible economic growth and speculation. The stock market was booming, but there wasn't really a readily available way for everyday people to participate in a diversified way. Carret saw this gap and decided to create a vehicle that would allow investors to pool their money and access a professionally managed portfolio of stocks.
So he was essentially democratizing investing,
Yeah.
making it accessible to people who might not have the time or expertise to manage their own portfolios.
Exactly. And it was a radical idea at the time. Keep in mind, this was before regulations and oversight that we have today for mutual funds. Carret was truly breaking new ground.
I can only imagine the challenges he must have faced in setting up something so new and innovative. Did he face any pushback or skepticism?
Oh, absolutely. Many people were wary of entrusting their money to a pooled investment vehicle. They were used to dealing with banks or buying individual stocks themselves.
So how did he convince people that the Pioneer Fund was a worthwhile investment?
He emphasized transparency, careful stock selection, and a long-term investment horizon. He wanted investors to understand that this wasn't about getting rich quick,
Oh.
but about building wealth gradually over time.
That's really interesting. So he was essentially laying the groundwork for the modern mutual fund industry as we know it today. But let's talk about the actual process of setting up the Pioneer Fund. What were some of the practical steps involved? I mean, did he need a special license or permit? How did he even find investors willing to take a leap of faith with this new concept?
It was certainly a different era. While the regulatory landscape was less complex then, he still needed to navigate legal and logistical hurdles. He had to establish a trust agreement, find a custodian bank to hold the fund's assets, and develop a prospectus outlining the fund's investment objectives and strategies.
That sounds like a lot of legwork.
Yeah.
And then there's the challenge of actually attracting investors. Did he advertise the fund, or did he rely on word of mouth?
It was a combination of strategies. He did some advertising, but much of the initial investment came from his own personal network and clients who trusted his judgment and track record.
So he was putting his own reputation on the line from the very beginning. He really believed in this concept.
Absolutely. And as the fund's performance began to speak for itself, more and more investors were drawn to its long-term approach and impressive returns. Remember, this was happening during a period of immense economic volatility. The fact that the Pioneer Fund was able to not only survive, but thrive through those tumultuous times solidified its reputation and attracted a wider audience.
It's a testament to Carret's vision and commitment to his investment philosophy. He wasn't just creating a financial product, he was building a legacy. But you mentioned earlier that Carret was a value investor, even before that term became popular. What exactly did his investment approach look like in practice? What specific strategies did he use to identify undervalued companies?
That's a great question, and one that we'll delve into deeper in the next part of our deep dive.
All right, we've laid the groundwork understanding Carret's philosophy and this groundbreaking creation of the Pioneer Fund. Now let's dive into the specifics of his investing approach. How did he actually put his value investing principles into action?
Well, Carret believed in, truly understanding the businesses he was investing in. He wasn't chasing after fleeting trends or market hype. He meticulously analyzed financial statements, looking for companies with a proven track record of earnings, strong management teams, and a durable competitive edge.
So it was about finding companies that were built to last, not just flash in the pan. Did he have a specific set of criteria, or is it more of an intuitive process?
He certainly had an eye for value, but it wasn't just intuition. Carret developed a systematic approach to evaluate potential investments. He looked for companies that were undervalued by the market, meaning their stock price didn't reflect their true worth, based on their assets, earnings potential, and future prospects.
So he wasn't afraid to
You
go
know.
against the grain, buying stocks that others might have overlooked or even dismissed.
Exactly. Remember, he was investing through some of the most turbulent economic times in history. While others were panicking and selling off their holdings, Carret saw opportunities to buy quality companies at bargain prices. His focus on value allowed him to weather those storms and come out stronger on the other side.
That takes a certain level of conviction and discipline. It's easy to get swept up in the fear and greed of the market, but Carret seemed to have a remarkable ability to stay the course even when things got rough.
He did, and that's a crucial lesson for any investor. It's easy to get caught up in the excitement of a bull market, but it's during those downtimes that true value investors can shine. They have the patience and fortitude to ride out the volatility and emerge with even greater gains in the long run.
Okay, so we've got careful analysis, a contrarian mindset, and the patience of a saint. Anything else we can add to this recipe for investing success, Carret style?
Absolutely. One of Carret's most important strategies was diversification. He believed in spreading his investments across a variety of industries and sectors.
Kind of like the old adage, don't put all your eggs in one basket.
Precisely. This strategy helps to mitigate risk. If one sector is struggling, his entire portfolio wouldn't be dragged down. This allowed him to stay the course, even when certain investments weren't performing as well as others.
That makes perfect sense. It's like building a strong foundation for your financial house. But even with diversification, markets can be unpredictable. How did Carrot stay on top of his investments and make adjustments along the way?
That brings us to another key principle: regular reappraisal. Carrot understood that businesses and markets are constantly evolving. What looks good today might not be so attractive tomorrow. He constantly reviewed his holdings, scrutinizing financial statements, looking for any signs of weakness or changes in the underlying fundamentals.
So it wasn't a set it and forget it approach. He was actively managing the portfolio, making adjustments as needed.
Exactly. And this ties back to his emphasis on intellectual examination. He wasn't afraid to sell a stock, even if it meant taking a loss. If he felt the company no longer met his criteria, or if its prospects had dimmed.
That's interesting. It seems like a lot of investors struggle with. Selling at a loss, they hold on hoping the stock will rebound, sometimes even digging themselves to a deeper hole.
It's a common psychological trap. But Carrot understood that holding on to a losing investment could be even more costly in the long run. He was willing to admit when he'd made a mistake and move on to better opportunities.
That's a valuable lesson in itself. It's about having the discipline to cut your losses
Hmm.
and allocate your capital more effectively.
Right. And it highlights another important aspect of Carrot's approach. He wasn't emotionally attached to his investments. He made decisions based on rational analysis, not sentimental attachment or fear of missing out.
So detaching from your emotions is key.
Yeah.
Easier said than done, I'm sure, but clearly a crucial part of his success. But remember, we're talking about a time. Long before instant stock quotes and online trading platforms, Carrot was making these decisions based on information that wasn't always readily available. How did he gather the data he needed to make these informed investment choices?
That's a great point. Carrot had to be resourceful and rely on more traditional methods of research. He pored over company reports, industry publications, and financial statements, carefully piecing together the information he needed. He also attended shareholder meetings, listened to earnings calls, and spoke directly with company management whenever possible.
So he was going the extra mile to really understand the businesses behind the stocks. It wasn't just about crunching numbers. He was looking for insights that others might have missed.
Precisely. And he understood the importance of context. He didn't just look at a company in isolation. He considered its position within its industry, its competitive landscape, and the broader economic environment.
It sounds like he was a bit of a detective, piecing together clues to uncover hidden value.
That's a great analogy. He had a keen eye for detail and a knack for seeing the potential in companies that others might have overlooked.
Okay, so we're starting to get a clearer picture of Carrot's investment style. Meticulous research, a contrarian mindset, a focus on diversification, and the discipline to reappraise and adjust his holdings as needed. But there's one more piece of the puzzle we haven't explored yet, his famous 12 commandments of investing. What can these commandments tell us about his overall approach, and what timeless wisdom can we glean from them?
Those commandments are a treasure trove of investing wisdom. They offer practical guidance and insights into Carret's philosophy, helping us understand how he achieved such extraordinary results. And that's exactly what we'll be diving into next. Stay tuned as we unlock the secrets behind Carret's 12 commandments of investing.
All right, we uncovered some of Philip Carret's secrets from his meticulous research and contrarian approach to his emphasis on diversification and reappraisal. But now it's time to unlock the wisdom behind his famous 12 commandments of investing. These commandments, laid out by Carret himself, offer timeless guidance for navigating the complex world of investing.
These commandments aren't just abstract principles, they're practical and actionable insights drawn from Carret's decades of experience. They provide a roadmap for anyone seeking to build wealth and achieve financial success over the long term.
Okay, I'm ready to dive in. What's the first commandment?
The first commandment is buy only into businesses that you understand. Carret believed that you shouldn't invest in something unless you have a good grasp of how the company makes money, its competitive landscape, and its future prospects.
That makes sense. It's about doing your homework and not blindly following the crowd or chasing after the latest hot stock tip.
Exactly. It's about being an informed investor, not a speculator. And this leads nicely into the second commandment. Always do your own research. Carret stressed the importance of independent thinking and not relying solely on the opinions of others. He encouraged investors to dig deep, analyze financial statements, and form their own conclusions.
So it's not about taking advice blindly. It's about seeking out the facts and making your own judgments. I can see how this would have been especially important in Carrot's time, when information wasn't as readily available as it is today. But it seems just as relevant in today's world of information overload, where we're constantly bombarded with conflicting opinions and so-called expert predictions.
Absolutely. In today's hyper-connected world, it's more important than ever to develop that critical thinking muscle and filter out the noise.
Okay, what's next on Carrot's list of investing commandments?
The third commandment focuses on diversification. Diversify your investments across different industries and asset classes. As we discussed earlier, Carret believed that spreading your risk across a range of investments helps protect your portfolio from the inevitable ups and downs of the market.
It's like that old saying, don't put all your eggs in one basket. So he wasn't advocating for putting all your money into just one stock or sector, no matter how promising it might seem. He believed in spreading the risk.
Exactly. He understood that even the most promising companies can face unexpected challenges, and that entire industries can go through periods of decline. Diversification helps mitigate those risks.
All right, what's the fourth commandment?
This one might seem counterintuitive. Be quick to take losses and reluctant to take profits. Carrot understood that cutting your losses on a losing investment is essential to preserving capital and avoiding further losses.
That's interesting. It seems like a lot of investors struggle with admitting they were wrong and letting go of a losing investment. They hold on, hoping for a turnaround, sometimes even doubling down on their losing bet.
You're right, it's a common psychological bias. But Carrot believed that holding on to a losing investment can be even more detrimental in the long run.
So he's saying it's better to admit defeat and move on, rather than clinging to the hope that a bad investment will magically turn around.
Precisely. He also believed that it's important to let your winners run. Don't be too quick to sell off a stock that's performing well. Give it room to grow.
Okay, I can see how that goes against our natural instincts. We often get tempted to take profits early, especially if we've made a quick gain.
Right. But Carrot understood that by holding on to winning investments for the long haul, you allow compounding to work its magic.
Compounding. That's a powerful concept. It's basically the idea that your earnings can generate more earnings over time.
Exactly. And the longer you stay invested, the more powerful that compounding effect becomes.
This is great stuff, but we're only on commandment number 4. What other pearls of wisdom did Carrot have to offer?
Well, the fifth commandment emphasizes patience. Invest for the long term and avoid market timing. Carrot believed that trying to predict short-term market fluctuations was a fool's errand. He focused on identifying undervalued companies with strong long-term potential and holding on to those investments, letting the market's ups and downs play out over time.
So he wasn't a day trader or a short-term speculator. He was in it for the long haul. He saw investing as a marathon, not a sprint.
Exactly. And this leads us to the sixth commandment. Focus on the underlying business, not just the stock price. Carrot believed that the stock market is often irrational in the short term, but that over the long run, the price of a stock will reflect the true value of the underlying business.
That's a great point. It's about focusing on the fundamentals, the company's earnings, its management team, its competitive position in the market.
Right. It's about separating the signal from the noise and focusing on the factors that truly drive long-term value creation.
Okay, I'm really starting to internalize these commandments. What's next on the list?
Commandment number 7 is all about managing risk. Use a margin of safety when investing. This means buying stocks at a price that is significantly lower than their estimated intrinsic value, providing a buffer against potential losses.
So it's like having a built-in cushion to protect you if things don't go as planned.
Exactly. It's about minimizing your downside risk and maximizing your potential upside.
Makes sense. What's commandment number 8?
This one is a classic. Be fearful when others are greedy, and greedy when others are fearful. Carrot believed that the best opportunities often arise when the market is in a state of panic or euphoria. He encouraged investors to be contrarian, buying when others are selling, and selling when others are buying.
So it's about going against the herd mentality and not getting swept up in the emotions of the market.
Exactly. It's about thinking independently and acting rationally, even when everyone else seems to be losing their heads.
Takes a certain level of courage to stand apart from the crowd, especially when the market is moving strongly in one direction. But clearly, Carrot believed that this contrarian approach was key to his success.
He did. And it's a powerful reminder that the best investment decisions are often made when you're going against the grain.
All right, we're on a roll. What's commandment number 9?
This one focuses on continuous learning. Never stop learning and evolving your investment approach. Carret was a lifelong learner, constantly reading, researching, and refining his investment strategies. He understood that the market is constantly evolving and that to stay ahead of the curve, you need to be adaptable and willing to learn new things.
So it's not about finding a magic formula and sticking to it forever. It's about staying curious, staying informed, and being open to new ideas and approaches.
Right. It's about embracing a growth mindset and constantly seeking to improve your understanding of the market and your own investment process.
Okay, we're getting close to the end. What's commandment number 10?
This one emphasizes patience and discipline. Avoid emotional decision-making and stick to your investment plan. Carret understood that investing can be an emotional roller coaster, but he believed that it's essential to keep your emotions in check and make decisions based on rational analysis, not fear or greed.
So it's about having a plan and sticking to it, even when the market throws you a curveball.
Exactly. It's about staying disciplined, even when it's tempting to deviate from your strategy.
All right, 2 more to go. What's commandment number 11?
This one is about seeking quality. Invest in companies with a strong track record, competent management, and a sustainable competitive advantage. Carrot believed in investing in companies that were built to last, not just flash-in-the-pan businesses.
So it's about looking for businesses that have a moat, a sustainable advantage that protects them from competition and allows them to generate consistent profits over time.
Exactly. It's about investing in companies that are built on solid foundations and have the potential to create long-term value.
Right, we've reached the final commandment. What's the last piece of wisdom Carret has to offer?
The 12th commandment is perhaps the most important of all. Remember that investing is a marathon, not a sprint. Carrot believed that building wealth takes time, patience, and discipline. He encouraged investors to focus on the long game, not get discouraged by short-term setbacks, and stay committed to their investment goals.
That's a powerful message to end on. It's a reminder that investing isn't about getting rich quick. It's about building a solid financial foundation for the future.
It is, and it's a testament to Carrot's vision and enduring legacy, that his principles remain as relevant and impactful today as they were nearly a century ago.
This deep dive has been incredibly insightful. Philip Carret's 12 Commandments are a treasure trove of timeless wisdom for any investor, regardless of their experience level or investment goals.
I agree, and I think the most important takeaway is that successful investing isn't about finding some secret formula or following the latest trends. It's about embracing a long-term mindset, doing your research, and sticking to a disciplined approach, even when the market gets turbulent.
Well said. Thanks for joining us on this fascinating journey into the world of Philip Carret, a true investing pioneer. Until next time, remember, Carret's wisdom, stay curious, and keep investing wisely.